The Federal Reserve continues to make mistakes. Did you see part one? Now we're going to go to part two, take us from 14 to present time and show the continual mistakes they make, but also how you can benefit. Let's go. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Have several articles down there on today's topic. Also, if you're looking for a different opinion than that of Wall Street and Big TV, please do consider subscribing. We do market updates and educational videos just like this. So this is part two of a two-part series. If you have not watched part one yet, it's right here. Click, watch it, come back, okay? Part one, we talk about basically 29 through the '08 crisis, what was right, what was wrong, a lot. The biggest issue is liquidity in '08 and the problems that have come from that. Part two, we're going to pick up where we left off, 2014 to present. Not only what they've done, the mistakes they've made, how it's just a cycle. They continue to make the same mistakes. So let's move over and check out the details. Okay, so starting at 2014, as you can see, this is when the Fed stopped purchasing or adding liquidity to the market. In fact, they finally started going down, and you can see that until October of last year when you had a couple hedge fund issues and we had some underlying liquidity going on. And then, of course, QE forever, as Chairman Powell says. They've continued an exorbitant amount. Now, the difference is they front-run this one, right? So they dumped $3 trillion in the front, where this one happened over time. Is there going to be a difference? What's the impact? Of course, we're going to talk about that. So the total impact is obvious here, right? So they dumped all this liquidity in the market, and guess what, right? The market goes straight up. It's like a risk-free market because essentially the Fed has given us protection on the downside. And each time there was an issue, they dumped more in, right? Operation Twist, there's your last QE. Okay, then the Fed stepped in over here and said, we're going to stop raising rates. Okay, and again, it just keeps on going and going. Is this a good thing? Sure, of course, it's been a good thing for the stock market, but has it been good for the overall economy and not just those that invest in the stock market? So we're going to get into that. So since 2009, the balance sheet has gone up 624%. I mean, think about it as an investment. You're going to put X amount of dollars in, right? You're looking for ROI, return on investment. Absolutely not. So you have an increase of 612% on the balance sheet. GDP just 34% over that time. Corporate profits only 47%, 41% growth on consumer sentiment. Wages 34%. That's total, folks. Total since 2009. Employment 3%. And underemployed 26%. So definitively, no, it did not have an impact. It did not help things, okay? So let's go further into it. This comes from the Brookings Institute. New chart, haven't seen it before. A lot going on here, but the bottom line is this. When you see the red, that's when the Fed dumps in money, and it shows the impact of that to growth and GDP. Okay, so they dump money in, you see an immediate impact and then a lag. Put money in and a lag. So here we had the biggest push ever, and look at the projections. Okay, it doesn't help long term. We see that. That's the problem with all this liquidity. It truly has not helped, and nor are we anticipating that. So what they've created is what's called a liquidity trap. Okay, so that is when injections of cash, okay, go into the private banking system from the central bank, which is the Federal Reserve, which fails to lower interest rates or stimulate economic growth, right? So this liquidity trap happens when people hoard cash because they expect bad things to happen, such as deflation, okay? Don't have the kind of demand or some type of war. Now, we don't have that, but obviously we just had this situation on the health front. Signature characteristics of a liquidity trap or short-term interest rates remain below zero. Hello, we're going to talk about that. Furthermore, fluctuations in monetary base fail to translate into fluctuations into general price levels. Okay, so let's dig deeper. Personal savings, woo, look at that. Number one, going back over time, it has increased. I mean, in fact, before 2000, it was negative. So it has continued to increase. We had a spike here, okay? And then look what happened as we went into our crisis this year. Folks were hoarding cash. Now it's going less. Now there's reason for that as well, with unemployment running off, etc. How about effective fund rate? Hello, 2% in 2000, right? We're negative right now. We are negative almost 2.6%. That is the Fed overnight lend rate plus inflation. That is not good. It's good for some people, but not good over the long term. So what is the impact when you look at what should happen from any type of monetary policy? Economic growth, number one. Consumer confidence, right? With that comes raising salaries, not 34% over the last 11 years. Expansion, growth, all the good things you expect. The problem is the actual outcome from the Federal Reserve's actions have given us low to zero interest rates. We just showed that. Minimum growth, we're going to talk about these. Non-productive debt, so people are basically taking on more debt. Corporate debt explosion, okay? The largest wealth gap ever in history. We're going to talk about that. No inflation, movement of money is down. Why is that important? We're going to talk about that as well. So here's GDP. Where's the growth been? We peaked at 3.2%. Keep in mind, China's been double digit for years. But really, we've averaged over the last 10 years about 2%, about 1.9%. That is not growth. And obviously, this shows where we are right now. Okay, this was last quarter, second quarter 2020, and we're still anticipating negatives going forward. Consumer debt, look at this. Okay, here's when the crisis ended. Look at that. That is horrific. Low rates, okay? Not credit card, low rates. People are buying, right, bigger cars, nicer cars, bigger houses. Sure, great. But if you've noticed, we've had these food bank lines. Look at the cars in there, okay? Everybody has gone crazy, did not learn from the '08 crisis, taking on additional debt. Look at corporate debt. Corporate debt is out of control, okay? Now, this chart wasn't updated. We're at $10 trillion in corporate debt, okay? We've added $2 trillion just since the beginning of the year. This is terrible. Now, you say, okay, low interest rates, they're borrowing, they're taking that money, and they're creating debt, right? So what do? Stock buybacks. Look at the stock buybacks, okay? Here's 2010. Look how high and how long, okay, corporate buybacks. That helps nobody. Well, shouldn't say that. It helps the shareholders because they're driving up the price. We showed you earlier, corporate profits only up 47% in 10 years. Okay, annualize that. So how do they drive the stock price? They buy back stocks, right? Because if they're buying back stocks, they're taking stocks away from the market. That's going to drive it up, and that is not a good thing. Now, here we are right now as far as what's going on. What's the issue today? This is from 2019 through April, but it's actually continued on. The pink is high yield. So the Fed now has stepped in and is basically protecting all these companies, zombie companies, all right? So this is a big issue that I'm watching every day. When and if we see a crack in the high yield market, okay? Because the Fed has stepped in. They're buying bonds, they're buying ETFs, doing whatever they can. This should not happen. It is just silly, but they've created all kinds of issues, right? The number one thing is they've created these zombie companies, meaning they don't make any money, okay? They make no money, yet the Fed is stepping in and propping them up. The Fed's corporate bond buying has created a stock bubble, without question, right? And then with what's going on right now, $1 trillion in new corporate debt, okay? And that's old, because that's going back a few months, okay? We're now at actually $2 trillion. This is not a good situation, something we watch every day. So what the Fed has done with all of this has created this massive wealth gap. Haves and have-nots, right? If you're not in the stock market, you have not, right? Shares of wealth. 87% of the stock market today is owned by 10% of the wealth holders. Think about that. Sure, the stock market has gone up, but the Fed's job is to help everybody, not just a select group. Mean value of net worth of families with holdings, okay? And it's showing you what's going on. And again, it's showing you that the rich have gotten richer. The top 1% have seen nearly a 300% increase since 1989. How about everyone else, right? The medium, right? 40 and 9%. I mean, think about that. So this liquidity, what they've done is by creating low interest rates, sure, if you have the money, you have the ability to borrow. You're in the stock market, you're doing fantastic. Everybody else, not so much. That is a big issue. So today, not today, but a couple weeks ago, they said, we're going to do what we can with inflation. And this shows you inflation over the long term. Since 2000, of course, the red is medical care. Okay, some things have gone sideways. That's actually apparel down there. Recreation, okay. So inflation has really been in check, as we've seen. So they're trying to raise inflation right now. So here's the issue. They're also devaluing the dollar. So you're devaluing the dollar, purchasing power, rising inflation. We are, in fact, seeing this. We're seeing this in our investments today, okay? What does that do? Well, if you have lower value of dollar, right? Purchasing power, and prices are going up, you're not going to buy it. What does that bring? We're going to talk about that. All right, so now we're going to give you a new term, money velocity. You've got M2, M1. This is M2 money velocity. What is that? Velocity of money. Is it moving through the system? Is it moving through the consumer? Okay? So what happens is, as investors get nervous recently, they pay less money to credit, companies become more conservative, reduce expansion plans, unemployment, okay? And consumers save more, spend less. So we can go back to 2000. The orange line is money velocity. It is crashing right now. Why? Okay? Because what happens is money velocity, when you look at it, okay, it's a classic warning sign of what is about to come. All right, so everybody is saving more. They're worried. Pessimism is increasing, and they're getting concerned. So what comes here next is deflation. So the Fed is trying to drive up inflation. But here's the problem. Once again, why they're behind the curve. You have a devaluing of the dollar, so purchasing power goes down, okay? Inflation goes up, what happens? People spend less, right? And that brings in deflation. And we're going to talk about how we handle that in a second, but this is big, right? So the Fed has constantly increased, yet money velocity has decreased because why? It doesn't go to the consumer. Go back to the wealth gap. It's going to the big banks and everyone else, keeping this market afloat, which is great. We saw who was part of that, and obviously I'm in the industry, right? But the idea is, how do you take all of this, Part one, now part two, the conclusion of where we are today, and benefit from it or prepare yourself. So now let's bring all this together. We went through part one, 29 basically to 2014. You know, the Fed had some issues along the way, but their debt wasn't bad until the '08 crisis. They managed recessions with lowering interest rates, right? The effective fund rates. And that worked. They used that going up and down over time. And in 2008, obviously they went to this crazy liquidity issue. So how does that affect us? Everyone, okay? The debt to GDP ratio today is 120%. What does that mean? What it means is if it's your household, okay, you're running at a 20% deficit every year. How do you continue? Okay, so for every dollar, right, you're going to spend more, 20% more that you bring in, right? It's simple math. That's called a deficit. That's why our deficit is out of control. So today, we're stuck in this vicious cycle due to the Fed's policies on recessions, okay? Debt-fueled consumption. Lower interest rates feels good, right? But they incentivize folks, corporations, and government to borrow more. Who gets hurt? Just had a meeting with clients. Interest rates, savers, retirees, right? What happened to a reasonable risk-free, right, money market that was getting you 3 or 4%? It's gone, okay? Now the benefits are here for a select few because the economic recovery is coming, albeit slow. The issue again is the cost today is going to be paid at some time in the future. Look here, this is the debt clock. It is out of control, right? I mean, it was just 20 trillion a few years ago. Okay, I'll have Andrew circle where we are today, right? But how much is that per individual? We'll circle that as well for you. It's out of control. So the question is, where do we go from here? What do you do as an investor? Okay, one is be nimble. We are clearly in a recession today. I said in my last market update, what happened in February was a flash crash because the Fed front-ended, put $3 trillion in right away. Right? Over the last time, they did it over time, and we saw this gradual move. But what happens? Can they continue to throw trillions of dollars if the stock market goes down? I don't know. I mean, they can, okay? But the problem is it's just going to stay in a cycle. Speaking of cycle, as I became more educated on the Fed, I started following the cycles more and implementing it to our investment philosophy. So here's our cycles today. We are in cycle 3 right now. Talked about it. Dollar down, inflation up. I will tell you, I am seeing signs of cycle 4. Cycle 4 is deflation, which I also just talked about. Certain asset classes do well in cycle 3, certain do well in cycle 4. Can't go over all that today. Our clients will see that. You can subscribe, and I do talk about it. But look at the cycle, right? When you hear the word TINA, there is no alternative, right? You have to be in the market because rates are so low. No, follow the cycles, okay? And utilize the cycles to your advantage with certain specific sectors. So, hope you enjoyed this. I've spent a lot of time on this. I've enjoyed it. It has been a great education for me and hopefully for you as well. Michael Loftus, Wealth and Wisdom TV.